But I think what's now really, really clear, and it has been kind of known to investors for a while, is that we are changing very quickly from that regime. The Washington consensus, I think, as we've ever known it, is probably on the decline, maybe even dead. And you're seeing that in headline news all around the world now. I mean, January started off pretty explosively, in my opinion, with what is happening with Venezuela in particular, that shows a different kind of US might that historically would have not been prevalent in international dialogues and relations. And we're also continually hearing about things that feel just really remarkably different culturally than we've ever known for what geopolitics means, right?
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming on Jeff Park. So Jeff serves as the CIO at ProCap Financial. Jeff, thanks so much for coming on the podcast, and Happy New Year.
Happy New Year to you as well.
Yeah, really looking forward to the conversation. It's the first time that you're on, and I've quite enjoyed your takes on, I guess, what you're seeing overall. So I'd be really interested in starting very broad. What are you currently seeing in the markets and the economy at the moment?
I love it. Yeah. And I can't imagine a better title than What the Finance to explain 2026 and beyond. Well, I think 2026 is going to be a continuation of some of the chaos of 2025 in the Trump administration. But chaos, as we know, is also something that presents opportunities. I like to always remind people that while people complain about volatility being a cause of uncertainty, the flip side of uncertainty is in fact opportunity. So we should think about that as a gift in the ways we can navigate preemptively if you're an astute, thoughtful investor focused on just what is happening with the reset of the global monetary framework. And that, I think, will be a continuation of a trend. However, I also think there's going to be something new that's introduced that is accelerating at a pace that may also continue to shock the markets. And that will create new thematics, new flows, and new imaginations for capital formation to come. And on that front, I think about AI and the way that it has exploded into the mainstream news, I would say really over 4Q and particularly towards Christmas with launch of Claude Opus and other agentic models that are able to really bring to life some things that people assumed would be quite theoretical for a little bit longer, but now in practice.
Yeah, really interesting. Well, we can get into that later, but maybe we start with the monetary policy. So you said you see it sort of shifting, I guess a new monetary policy order. So what is your thesis there, and why do you think that's happening?
Sure. So every, I think, century or so, there's a reset of a global monetary framework based on the ever-changing kind of dynamics around the countries that are in power, right, ultimately, and the kind of sovereignty that exists around how they decide to monetize their own authority in the global supremacy. And what we know really over the last at least like 80 years post the World War II era is that there was one version of a US-centric model that has been perpetuated based on the dollar hegemony that I think has served the world very well, trade liberalization and lifting global poverty out and bringing prosperity to the US. And I think all of that is based on what historically would have been called the Washington consensus, right? Which is where Washington is the center of the security agreement across the world. And because of that, we can rely on peace and prosperity so that resources can be actually invested towards productive gains and not potentially in things that are less productive as ways of having insurance like defense and military and things like that. So that was great. But I think what's now really, really clear, and it has been kind of known to investors for a while, is that we are changing very quickly from that regime. The Washington consensus, I think, as we've ever known it, is probably on the decline, maybe even dead. And you're seeing that in headline news all around the world now. I mean, January started off pretty explosively, in my opinion, with what is happening with Venezuela in particular that shows a different kind of US might that historically would have not been prevalent in international dialogues and relations. And we're also continually hearing about things that feel just really remarkably different culturally than we've ever known for what geopolitics means, right? And so I think part of this is ultimately because at the center of it is the issue with like the U.S. dollar. The U.S. dollar, meaning that it is continually experiencing a federal budget deficit at a global scale, where we continually need borrowers in the market for our treasuries. And that market is actually probably more chaotic than it historically ever has been, right? And you're seeing that in the long end of the treasury curves, 10-year, 20-year, 30-year out, where we're not seeing it kind of moving as in line with the short end of the curve. So I think the big question for 2026 is going to be, yes, we are having rate cuts probably into the cycle, and everyone is anticipating maybe two more cuts. Maybe it'll be 50 bips. Some are calling for 100 bips. And the question isn't about that amount, I think, that matters as much as what is going to happen to the long end of the curve based on the compression we see on the front end. And are we actually going to see a kind of like a decline in the steepening as it exists? That's the trillion-dollar question. And there are a lot of bond markets analysts who think that we're not going to breach anything lower than 4.3%, 4.2%, no matter what the short-term rates are, because they have their own models to think about what inflation is going to be on a perpetual basis going forward, that we're not actually ever going to go below a 2% inflation regime. And so when you factor all these things in, the dollar is basically changing. And when the risk-free rate stops behaving like the way that all of the investing models have ever been built off of, what I generally call like the intelligent investing framework, it's time for a new model. And so I wrote a piece last year called The Birth of the Ideological Investor, which is to contrast to the intelligent investor, because we have to fundamentally start challenging some of the assumptions about what investing is going to look like when the risk-free rate is no longer the risk-free rate, but potentially what we might even want to call the risk-full rate. And I think that's the genesis of the open mind that we really need to have as investors in the community to think about outperformance in the future, because what worked in the past, I don't think is likely going to be the thing that works in the future when the world is actually being reset to fundamentally different standards.
Yeah, super interesting. And what do you think has been a driver of the shift? Has it just been overextension of the US militarily, I guess, especially in the Middle East during the early 2000s, or maybe it was just too much overall for a country to handle in the rise of China? Do you have any perspectives on that, or does it not really matter?
Well, look, I think there's always been a big trade imbalance that needed to be addressed, and this is not new. This has actually been ongoing even since like the recognition of China's entry into the WTO, that this would become a conversation to be had in the distant future. And we've just arrived at that point where the trade imbalance is actually creating all kinds of distortions in the global economy, right? And it's funny, like sometimes when you peripherally read the mainstream media or press, the topic becomes a little bit oversimplified, where Americans have a consumption problem. Americans overspend and don't save enough. And it makes it almost look like that is like a choice of sin by Americans. But the reality is the structure of society was set up in that way, where overconsumption is actually the driver of how the US economy itself sustains itself, by also then having capital account surpluses. So on the other side, you can make the exact same argument that China actually saves way too much and they don't spend. And that too is not a virtue, in the sense that to actually have a reconciliation of a healthy functional market, you need to drive some internal demand for consumption as well, to kind of create more balancing. And what we're realizing is that there is no balance. And China, in one particular version, I think, has been fairly authoritative in their ways of wanting to still continue to lead with an industrial policy. And so here's the thing, like, to dance, you need to, right? To tango, you need to. And if one party does not play by the same rule, then it's really hard for the other party to kind of make ends meet. And what I think we're just now seeing is that the US is more likely to move towards kind of the Chinese version of the industrial policy, to meet somewhere in the middle, if China is not able to kind of open their own capital markets to permit more consumption in their own economy, to meet in the middle too. So we're just seeing a convergence of things that historically was more kind of risk removed. And that just has a lot of implications for what it means to have a foreign policy in the US that ultimately turns to a successful domestic policy. Because, the dollar being at the center of global finance really is both a blessing and a curse, because the dollar can help with the export economy based on where the dollar's strength is, but it also has implications for the import economy and to the price of goods and how Americans are able to actually consume. And so when you think about the dual role of export versus imports and the role of savings versus lendings, there is probably a market clearing price that we are trying to discover, where we do need to kind of reinvest into some domestic capabilities here in the US as well for industrial production. So I think these trends are long lasting. This is not going to be like a one-time haphazard effort by one administration. We're on the course now for decoupling. And in that world of decoupling, it just means that the past data and models are not going to reflect what you can expect in the future, because it's not a world that I think we have enough data points to understand what the implications are. So it's a really exciting time, I think, to be an investor, because it allows, kind of for the first time, in my opinion, for those with thought leadership and real edge in having the agency to determine what the world order is going to look like, to make some preemptive views and calls and place their chips in ways that necessarily don't have to compete with like high frequency trading or low latency kind of market scalping efforts that is really the dominant force of the capital markets, when there's no volatility and there's no direction and it's just money kind of flowing within the system. And now we're kind of seeing money move in ways that are more ideologically driven. And that means that, as humans who have ideology, it's a really exciting time to assert your views and actually, put money where your mouth's at.
Yeah, really interesting. So how do you see this shifting, I guess, the markets? Is it going to be similar to China? And I guess that hasn't really benefited from that shift, or what is your view?
Yeah, I don't think this means that the US capital market is going to look like the Chinese capital markets by any stretch of the imagination. What it means is that the catalysts that are able to create market activities are going to be more ideologically driven than otherwise driven by the forces of market clearing capitalism endeavors. So in China, regardless of what you think about the total wealth creation of its stock market, the events that move markets are administrative in nature by government decree, right? Like you see the tech stocks move based on kind of the Politburo's decisions as to how they communicate where people are going to invest. You can pick longs and shorts, really anticipating how the Chinese Communist Party is refocusing their agenda that they outwardly communicate. So I take, for example, once upon a time, trading names in the education sector in China was a big boon because people were investing in education. It was very profitable, but it got to a point where the overinvestment in children's education was creating wealth inequality gaps more noticeable, where there was unfair treatment for certain children versus others. And the government decided this is not healthy for society. We're going to shut down all these after school tutoring services and pro-education companies, or at least limit their growth. And then the stocks all, of course, perform very poorly. And so what I mean to say is, like, it doesn't matter what your Excel model tells you the growth rate of a company is based on its past experience. If one day you wake up to the news, the government decides to change their mind on their growth trajectory and they're going to start putting all kinds of restrictive covenants. Education is one sector, but you see it all the time with gaming, property. I mean, the entirety of the Chinese market at some level move with this like tail risk of like, what is the government going to actually do? And what I'm saying is the US market is starting to look really similar from that perspective. The US government's outward communication of where they're going to invest their energy towards national security has become really topical. And if you think about kind of the outperformance sporadically that you see in quantum computing, or to certain data infrastructure companies, or to AI companies that are receiving direct kind of endorsement by the government sector, like those things tend to now play a dominant role in moving markets. Take, for example, again on Venezuela. No one kind of anticipated you'd wake up one day here in the US and see Maduro was being transported here to New York. But the next day, the most immediate thing was all the energy names in the US that basically have some ability to harness that opportunity set that is now available in Venezuela, plus the reparations that potentially become available via remedy in past mistreatment for certain companies like ConocoPhillips, trading up intensively because of a government action, right? So to be an ideological investor means at some level, it's not really important what the Excel models say, because whatever the Excel models say is already, you assume, perfectly known by the investors and it's priced information. The way to make money, of course, always is to anticipate unpriced information that is going to change markets. And I think we're now just seeing outsized endeavors there that are coming more from binary events or discretionary events that are kind of driven by some human agency. And in the end, this is, I think, good for retail investors, because those kinds of information, edge and volatility, is not the kinds of things that institutions historically are betting massive size in, right? Because institutions are not in the business of trying to predict these types of big moves based on a whim of an action. But the reality is, when you create these types of opportunities probabilistically that are like 3 standard deviation type events, those are actually things that individual investors can get ahead of institutional investors, because they can move without needing as much size and footprints to move markets.
Yeah, it's really interesting. I guess, that's been a massive trend over the past year and a half, 2 years. But then if we look back to 2022, it was a similar trend, and then we saw quite a large crash, very cyclical. So do you see that cyclical nature continuing, where it's actually just trying to find the next, I guess, ideological trade to get on before it collapses? Or?
Well, let me also double click on what the implications are once you embrace the idea that ideological investing is the future. What ends up happening is this possibility to marry a new paradigm of investing models that will change the nature of fund flows that we haven't seen in the past. So those who may remember, after 2008, 2009, there was a big question as to whether the passive management investment industry will underperform or outperform the active management industry. And you have to remember, back in like the early 2000s, the passive industry was probably 10% of the total market share of all investment funds. Most products were actively managed funds and strategies, mutual funds, hedge funds, things like that. Now, I believe it was 2023 that passive finally overtook more than 50% of the lion's share. And now it's closer to like 70% of all investment funds are passive flows, right? These are index funds, tracker funds, rules-based ETFs that are thematic in nature. But it has won the marketplace and won the hearts of how investors want to access their investment programs. So what I think is going to happen is, going back to the rise of AI, which is another contributor to the world of ideological investing, you now have this ability as an independent person to have a robo kind of investment advisor that you can consult and prompt and seek context to determine how you want to invest in your portfolio, right? And so when AI agents are able to give you kind of portfolio recommendations and name selection recommendations based on the prompts to which your ideological pushing, kind of what your own interests are, this is like a new paradigm of a product that is neither active and neither passive, right? It's not active because it's still constrained by some type of rules-bound way that these models are telling you what they think are the investment approach. But it's also not passive because it's not actually deterministic in nature, right? Like you've created an outcome that is a one of one for yourself that is not broadly accessible to others. And so what you end up creating is these independent investors who want to have more agency over how they choose what they want to do with their money. And they consult these AI agents to help be a co-pilot to your investment thesis and ideas, driven by likely some aspects of your own ideology. And those things start creating flows, right? And so, the reason passive outperformed active for so long in some ways is because the flows have been so dominant, right? There's been so much money coming into index funds. And now you have to imagine for the next 10 years, it might not be passive funds, but this idea of like an ideological portfolio created by your AI tool that lets you kind of have more agency towards the principal investment risk you want to take upon. And to me, like, this is a very interesting way to imagine what flows are going to look like in the future, because now you have to imagine how the AI models consume the information that is widely public and available, being the source of then providing recommendations as the engine for kind of the next chapter of capital formation. So I think there's a lot of interesting implications there, but I think what you can take away from all this is a pretty clearly distilled insight that ideology is at the center of everything, right? Because these prompts that everyone will exercise on their own discretion will be rooted in some level what you personally believe that you want to be accomplishing and doing with your own portfolio. And that ideological flow has the chance to be more pervasive now with the technological tooling that is available that wasn't in the past.
Really, really interesting. I guess the challenge then is, even if you have this ideology, how do you know it's going to be it's going to outperform? I guess you need to think there's a network of other people who sort of think similarly to you. But that seems to benefit, as you said, the retail investor versus the institutional investor.
Yeah, I mean, it's kind of like this, right? Let's say like you actually think, for whatever reason, as improbable as it is, that somehow the U.S. is going to take control over Greenland, right? Like, it's so risk remote, it's so improbable, and yet, like, let's assume you have a view on this. You couldn't go out there and find an ETF that tells you like what the exposure you would get based upon that event occurrence. It doesn't exist. But now you can actually build that portfolio if you have the ability to clearly enunciate the context required to then have a portfolio recommendation based on the factors that you think are going to be driving on that one event, right? I mean, and that's an ideological bet at some level, but now you get a portfolio. And so what I'm trying to intuit here is that some of these fund flows that you're going to see is going to preempt the ability for indexes to have ever existed, because indexes take time also to propagate. It takes time for these ETFs to launch. You almost don't need that at some level if you are able to kind of build your own portfolio in a custom way using these toolings. And those flows will get ahead. In other words, like, index inclusion is a big business, right? Hedge funds and quant funds and market makers play this game every quarter where they try to figure out like what name is going to get included in the S&P index and what name is not going to get included in the S&P index, get removed. And they try to, like, quote unquote, front run that investment thesis. So, they'll buy AppLovin in 3Q, hoping that AppLovin is going to get into the S&P 500. And if it did, great. As it did, the stock rips, because now there's going to be passive flows that are created by that index inclusion, and you were able to get ahead of it. And so that was a great trade. Now there's a world that AI inclusion is going to play a similar role, which is that it's not a defined index by some committee or some rules-based methodology that is preemptively like communicated where you can play some probabilistic games. But now it's more about like, what are the people going to prompt their kind of robo advisors to invest in based on their belief that you think that you're able to then get ahead of. So you get ahead of the AI inclusion trade. And I think that, is going to likely be a long sustainable trend in the futures, especially as you start seeing the proliferation of these AI agents being used in that way by investors in a more public format.
Okay, yeah, it's a really fascinating way to look at it, and I guess something that I hadn't thought about before. So if you go to 2026, maybe this will be a driver in 2026, but are there any assets or anything that you're watching that you think could outperform, or is that maybe not how you look at markets?
Yeah, look, I think everyone should try to have a diversified portfolio, and at the same time recognize that diversification for the sake of diversification is probably not a worthwhile endeavor. the most ideal outcome is you just create a portfolio that has multiple ways to win and that they're orthogonal to each other, but still alpha producing in the end, so that you're not necessarily investing in like a cost center for diversification benefits alone, which is a little bit different than how institutional investors historically approached the 60-40 model or the risk parity model, or the portable alpha model, as others call it. So, my approach is generally, figure out kind of thematically what will capture attention, that you have some ability and foresight to be at the right place at the right time, and use that leverage to build interesting positions where in the end, I think what my guiding principle and my North Star has always been is to really go long volatility, like to really bet on kind of volatility to signify not just like an annualized standard deviation concept, but more of like the fat tail, in which like the improbable things that are also high severity that people have a very hard time, as the human brain cannot comprehend, are usually the things that are most mispriced. Because when it's both improbable but really high in severity, the multiplication of like a very big number and a very small number is not intuitive for humans to really model very easily. So to me, like building a portfolio of a lot of those kinds of bets over time, I think tends to be like a worthwhile strategy. To that extent, I think I have to mention Bitcoin is one of the most interesting bets this year, and will continue to be, I think, for a long time, because precisely it is such an orthogonal vector for outperformance that just looks and behaves differently than most of the institutional asset classes. I also think like you should have a view on rates in general, and there's many ways to play a rates thesis. So not just the directionality of the front end, but you can make a view on the curvature of the actual tenors, and based on your own projections of like the steepness or the richness that you think the curve will experience. It's not just interest rate that you can play. You can also play on different asset-backed securities. You can play on agency, MBS. There's other types of securities that have different convexity profiles based on kind of the path dependency of the rates duration for the year. And so there, I think, my view is we are probably going to have more rate cuts to bring the front end definitively lower, at least 50 bips, possibly more. But I have a view that the long end of the curve is probably not going to move as directly in line as people anticipate. That the long end actually is a little stickier, that it could actually maybe even steepen on the long end where rates are higher if there is continued risk towards how people perceive U.S. credit worthiness in the long run, if there are outstanding issues that are not addressed. And so I think there's some tolerance for this that I have an open mind to. And of course, that's where the Fed gets really interesting in how they try to step in. Because right now, the big news too is, as of December, QT having ended, people think that we're approaching another expansionary tail of monetary reserves, and in a factual sense we are, but what we're currently doing is really just controlling for the front end of the curve with these reserve management purposes, and those look fundamentally different than yield curve control, I would say, on the other extraordinary end. So there's elements of this where I think the long end will be really, really interesting to watch. And it's because, again, it's at the center of like geopolitics, but also AI and what that might mean for deflation, as people anticipate that technology often creates. So those will all be really interesting. I also think gold is still going to be a worthwhile trade. As much as Bitcoiners really want it to be a Bitcoin only world, the reality is gold has still most of the developing world's mind share when it comes to an asset that succeeds at wealth preservation. It's probably not going to be, I think, as of a linearly historic run as we've had it, but my instinct is that it's going to continue to go higher, because the jury is out the door that monetary debasement is not going to stop in the near future. And especially when you see things like tail risk events like Venezuela, there's just more risk-off sentiment towards those who want to hold their wealth in a version that they can trust. And I can see that becoming a more dominant narrative, which is good for Bitcoin, but it's also good for gold.
Yeah, great. Thanks for laying that out. So, Jeff, thanks again for your time today. We sort of covered quite a lot, and it's really, really interesting to hear your opinions. But my last question is, what is one message you want people to take away from our conversation?
Yeah, in the ideological investor, I mentioned really 3 prongs to assess the opportunity set for the new world era. And one is geopolitics. We talked about that a little bit. We talked about AI. That's the second one. And the third one that I mentioned is focusing on culture and really understanding the cultural mood and where the world is going to be able to make idiosyncratic bets. And to me, culture is the one defining parameter that could most appear to be, at least today, AI resistant, because all of us have the self-sovereignty to be a culture contributor and a culture maker. And for that reason alone, the lesson I want to enthuse to anybody is to always continue to be able to live in a world of self-determination where you're able to make these investment decisions not through like a black and white yes or no kind of way that sometimes I think the frenzy of politics and social media makes it feel like we have to live in that world, but across a more probabilistic arena where we're able to see nuances in nonetheless the world order that you hold, but realizing that that probabilistic approach is actually what gives all of us a fundamental edge that deterministic models do not. And if you believe humans are at the end non-deterministic creatures, which I tend to believe, at a spiritual level, we all must practice that more mindfully and assert some agency of our own. So that's kind of my one otherwise cultural moment that I think I would love to share and enthuse upon, because I think the relevance of how AI is intruding our ability to have self-determination is going to be a really, really hot topic in 2026.
Yeah, amazing message. So, Jeff, thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Yeah, you can always find me on X. My handle is DGT10011. And then if you see my profile, I also have a Substack there, which I try to post some longer form writings too. So hope to find you in either of those places.
Great. I'll put that in the description below, but thanks again for your time.
Thank you.